Hello, this is George with the Harmony Trading System coming to you from Frisco, Texas. And let's get this baby on the road, talking about the market and the epic debacle that was the May contract in crude oil going to zero. Never happened ever in the history of the futures market. And let's take a quick look at where we at in that story. And it's quite the story. And let's take a look here. Obviously, this is a erroneous quote, but the market intraday blessed us with a negative. So what happened here? What was the catalyst for it? And is it supposed to happen that way? And the reality to that is no. Typically, that market is an orderly market. And let's take a look at what happened earlier. Yeah, that's just all baloney. Let me see here. Yeah, you got to the zero, then that's it after that. So the market went actually negative at one point, which led to, I think, a stop with that market. So what happened? What happened? Let's get to it. May contract is due to expire tomorrow the 21st. Third week of the month is typically when these contracts will expire. And the rollover process is typically a very orderly one, where the actual forward contract expires and the second contract, which is the next month contract, will start picking up in volume, and the moving on volume from the prior contract to the new contract is typically an orderly a deal over few days. Typically, the difference between the forward contract and the second contract is about 30-40 ticks, not much more than that. Today, the difference was monumental and ended up where the contract went to zero, while the actual contract of June is around $21 right now. So with the crude oil WTI versus the Brent, the WTI has a provision that you cannot settle the actual contract for cash, and you have to, if you stay in that contract through expiration and through the rollover, you are expected to take delivery of 1,000 barrels of oil, which is 42,000 gallons. For that, you have to take delivery per contract. So that's, people don't want to do that. There's no, the people who usually take delivery don't want to take any delivery because there's a glut in the market. And about 70% of all storage in the world for oil is preoccupied and taken at this point. So there's no incentive for these guys to actually hoard or take any more crude oil than they need to, because they already have too much of it to begin with. So they pretty much didn't want to do that, and the price they're just trying to get out of that contract as quickly as possible, and the value of it just plummeted in such a fast way that it really crushed people. You never seen that go down to zero before. Now, if you go and look at the new contract, we call it the new, but it's the June contract, we are trading around $21. Now, this is the ticket going forward. What happened if the same problem in WTI still exists in June, at the end of June? Is the price going to do the same behavior? That is the unknown, and that is the big issue that could really hit that market in a monumental way, is if they do the same thing to this contract, the June contract, like they did to the May. Okay, so whoever is wanting to trade crude or is traded on an intraday basis, make sure that when you get close to the actual rollover time, that you roll it over and not wait till the day before or a few days before you start that process, because quite possibly that style of panic could come in again and rear its head. If you are interested in a long-term play in oil, you could get the producers, you could get the equipment manufacturers, and you could also get USO, a dollar sign USO. And USO is an ETF. It has its own problems, but at the same time, when this front month or the May contract went to zero, the maximum exposure USO got, and I could look it up for you here, was like 10%. So let's just take a look at that quickly. Quote USO, here we go, boom, boom, let's see. USO price. Yeah, what a day, man, what a day. What a day, here we go. Yep. So we're looking at that price right here. 375 was 10%. And it got flushed pretty hard toward the beginning of the middle of the day, came back a little bit, but it kind of crashed. And it's more diversified than just buying the front or the current month, which is May. It's a lot more diversified. So it didn't take much of it took a 10% hit, still big, but not as bad as losing all your money in the future market. Okay. So what is the play? What's to look forward to in crude oil? You have a huge gap that happened. That gap is going to take some time to actually recover. You're looking at 21.25. You are shorting in rallies in this market. The next step for this price, we target number 4 is 27.32. So we're trading under that. The next target is going to be 14.6. That is target number 5 per the system. So we're looking for rallies as an opportunity to get short. There's a gap between 24.56 to 22.09. That market needs to hold that gap. Then lower prices will be just a function of a time during the week into the end of the week where we could see a dip below 20 and migrate toward that 14.6 on momentum. When will I reevaluate that idea? That idea is 23.27, and if we start breaking above that, that means that rally has a little bit more oomph and more energy. That takes us to 27.32, and we'll reevaluate the short around that time. That is on the bigger picture. If we're looking at closely intraday, we're looking at the market from 10 to 20 ticks and managing our risk along the way of 10 to 20 ticks on signals where our system will generate an entry and an exit. So we're not going to, but if you're trading this on a swing basis, you're kind of looking at these levels. You don't want to, as a short, you don't want to see the high 22.31. You don't want to see 23.27. You sure the hell don't want to see 24.62 as a cover of that gap. Okay. A historical day. This has never happened where a future contract goes to zero, but this is unusual times, and we have to kind of adjust to them. Okay, so let's take another look here and take a look at NQ, our baby, and we are doing good in that stock, or not in that contract. Let's see what we've done today while it's loading up. I think I made about 1,000 in that contract. And the market overall, and it's amazing to see the discrepancy between the story of crude oil versus the story of the indexes like NQ and SPY and the Russell 2000, Dow Jones. all of them are showing a lot more strength than the crude oil. So when the crude oil story is telling us there's so much glut due to the fact that there is no demand and there's no movement in economies around the world, the index traders are saying, okay, we know this, we know it's bad, but it's going to get better. Because that's the only thing that you could, rationalize why the indexes are still holding up the way they are versus where crude oil. And the crude oil story is one of recession, while the story of NQ and the rest of the indices are more of hope. They're hoping that this will be something that we're going to pass fairly soon and will be at an all-time high. Now, I tend to think, I'm just looking at this price action, that this price is very vulnerable to any complication in the markets, any bad news, any resurgence of virus around the world, and the speedy of infection. Any of this can come back and haunt this market and put a shadow and a cloud over the movement to the upside. You got a couple of things. The reversal that happened today is unique in the fact that you never seen a market does this before, where it's like, I've never seen this formation before, and I've been trading for 20 years. You're looking at, let's look at that right here, where the market kind of gaps up, always goes all the way to the bottom, comes back up and sells around 88 or settles around 88.04. You got a market that opened up, ran all the way up and came back down and settled at the bottom of it. So you're getting this flip-floppy type of price action that is unique in the way it looks. What does it mean for tomorrow? You have a very solid resistance levels, 87.84, 88.07, and you got 88.47. And all those levels are going to be resistant levels, and I'll be more in tune to, willing to go short on rallies versus looking for dips as a buying opportunity at these levels. And the major test for the bears is going to be 84.83, and that's the beginning of that gap that we did on the 13th into the 14th, and that gap is 83.24. It's a big gap, so the shorts need to come and challenge that in a major way. Now, when will I reevaluate my stand and say, okay, well, hey, listen, this market has more to go on the upside. Let me just, bite the bullet and start buying in this. If I start getting price action above 88.50, I will, on an intraday basis, I will be more in tune to go long than short at that time. It's going to take some work for the market to get there. So till we get to that price, and definitely resistance level of 87.90, in rallies into that area, I'm going to look as a sign that the market is giving me an opportunity to go short. If it shows any strength above that into higher levels, I'm going to pause and just wait for it. If we start breaking above 88.50, I'm going to change my stance and start looking for pullbacks as a buying opportunity. That's the big picture stuff. And intraday, we're flexible. We're looking at the 20 NT Renko and the 12 NT Renko as our signals to go short or long in this market. Okay, so let's see what else. What about ES? Let's take a look at ES. I get a lot of people asking me about that instrument, and here you go. All right, same kind of formation, a little bit stronger than NQ in the way it behaved, but this is very vulnerable to resistance into target number one. Anywhere around 28.41 is a bit of struggle for that instrument. You're looking for those rallies up to that level as a shorting opportunity, and you're looking at 87.50 also that will pick up momentum anywhere under that. It's going to take some work to get there. I've noticed a couple of things. The price action is becoming a little bit more orderly, where prices fluctuate in a very tight range. Price action slowing down. It's not spastic and erratic and parabolic like it used to be in weeks past. So that it's good to see some sense of normalcy coming into this market, and it's a lot more easier to trade it now than a few weeks back, even though the ranges are not as expansive, but you could handle the fluctuations versus in the past it goes up 30-40 points in matter of seconds, and usually it takes 15, 20, 30, 40, and sometimes an hour or two to make that range happen. So it's good to have a little bit of slowdown in this market. So that's kind of our perspective on ES, perspective on crude oil, perspective on NQ. At the end of the day, you have to manage your risk very tightly, and this is what we've done for today. We had one trade that we added to, did not work. The rest of these trades kind of came out fairly good for the most part with very low risk parameters. We ended up the day up $1,222 on 9 decisions, and we were happy with that result. Okay. And with that, we conclude our presentation. If you have any questions over any of these instruments, or you would like to see other instruments included and reviewed, just let us know. We're happy to include it. And with that, stay disciplined, stay focused, always smile, and remember to trade in harmony. Have a good one. We'll see you on the next video.